Bank accounts, credit cards, mortgages, personal loans, all of them use compound interest. To successfully manage your personal finances, it helps to have a basic understanding of compound interest and how it can grow your capital. You will find that it's not complicated and can be used to your advantage to get the most of your finances. How does the compound interest work? Compound interest accrues not only on the original investment, the principal, but on the entire balance of your account, including the interest accrued since you invested the principal. Hence, it's essentially interest on interest that leads to exponential growth over time. To further illustrate how compound interest works, suppose you put 1000 euros of equity into an account that earns 5% compound interest each year. So, in a year, you will have 1000 euros plus 5% of 1000 euros, which is 50 euros. In total, you will then have 1050 euros after the first year. This is where the compound interest comes into play. At the end of the second year, you will not simply earn another 50 euros in interest. Your account will earn 5% of 1050 euros, or 52.50. In total, you will have 1102.50 euros. The table below shows how much money you will have after making that one-time deposit of 1000 euros after 10 years. As you can see, compound interest is a powerful tool. Your original deposit and interest amount grow exponentially over time as the euro amount that makes up 5% grows. How to take the advantage of compound interest? Obviously, putting your money aside in an interest-bearing account earns you more money than you would get by keeping it under the mattress. But what can you do to maximize the magic of compound interest? 4 little tips to apply in everyday life. Number 1. Start saving now. When it comes to interest, your biggest ally is time. In the example shown earlier, you can see how much more interest you earn if you are willing to save for 10 years instead of just 1. If you are saving money for long-term goals, like not having to worry about working as you get older, your best bet is to start saving as soon as possible. The earlier you start, the more time you will have to grow your money. Number 2. Raise the savings bar. If time is the most important factor in earning interest, even the single euro has its importance. It's a nutshell. The more money you save, the more interest you will get. This is a financial health tip that may seem obvious, but it's worth pointing out. So make savings is a priority in your life and keep it that way. Putting away a little here and a little there will add up over time, especially when your nest egg will accumulate more interest as a result of the capital increase. Number 3. Choose your accounts and investments wisely. The interest rate you are getting on your savings plays a huge role in how quickly your money will grow over time. With that in mind, it's worth making sure you get the best deal before you even get started. If you have already been a customer with your bank for several years, take a look at the market outside your bank and make some comparisons with others. What interest rates do other banks or lenders offer on their saving accounts? If some or all your savings are deposited in an interest-free checking account, try to diversify, perhaps by looking for a financial institution that offers deposit accounts with interest. If your money is invested in the market, check regularly to see the trend and do not be fooled by promises of very high returns. Make sure you strike a balance between the potential growth of your money and your risk tolerance. Number 4. Break down the debt. Remember that compound interest is your friend only when you own the money. When you are in debt, compound interest works against you. Every month during which you use your credit card, or if you are unable to pay the monthly installment of the personal loan, you will have to pay the amount you have debited and also the unpaid interest you have accumulated. The best solution is to become proactive in paying off the debt faster. Pay more than your minimum and adopt a proven debt reduction strategy. Explore your options for reducing the interest rate on your debt. Conclusion. When it comes to compound interest, there is no financial sleight of hand, just regular financial checks. Magic happens when you strive to save what you can and reduce what you owe. Now that you understand what compound interest is and how it can work to grow your money, you are well on your way to taking control of your financial health.